This is Nightly Business Report with Bill Griffith and Sue Herrera.
Hitting a triple, the Dow, S&P, and NASDAQ close at records as the 2019 rally picks up steam.
Bump in the road. Uber loses its license to operate in London, raising questions about the company's future in its most lucrative European market.
Farm aid. Many thought government help for the trade war would go to the heartland, but that's not necessarily where the checks are being sent. Those stories and more tonight on Nightly Business Report for Monday, November 25th.
And we do bid you a good evening, everybody, and welcome. Well, it was a record start for the week for the stock market. The three major indexes all finished at all-time highs today, powered by technology shares. A handful of major deals were confirmed, which helped lift the mood, and we'll have more on that in a moment. And Wall Street's view of the U.S.-China trade negotiations, which seem to change daily, well, they were optimistic today, and it all contributed to a continuation of this latest rally that began in early October. The Dow was up another 190 points. We're back above 28,000. NASDAQ was up 112. The S&P added 23. Mike Santoli takes a closer look at whether the new highs can hold.
Wall Street's record rally has slowed in recent weeks, but it has not yet stopped. While the broad S&P 500 drifted to a fresh all-time high Monday, it is up only a fraction of a percent over the past 10 days. Now, with the index ahead by nearly 25% for the year, the question turns to whether the rally has already priced in most of the expected good news on the economy and trade, or whether the market is merely pausing ahead of a typical homestretch run higher through December. The key drivers of the market's recovery since August remain in place. Rampant recession fears in late summer now appear unfounded. Global growth is showing signs of picking up. The Federal Reserve is on hold with rates at benign levels, and seasonal factors favor stocks near year end. And history shows that when the market gains at least 20% in a year, the following year is also up about 70% of the time, albeit with more modest gains. Still, some analysts are quibbling with the market action here and there. The portion of all stocks that are keeping pace with the major indexes has fallen off a bit. The economically cyclical stocks that led the way off the August market bottom have flagged somewhat. Bond yields have retreated from recent highs, causing some to question the consensus expectation for a growth acceleration soon. And stock valuations are about as high relative to corporate earnings as they've been this decade. So it's easy to make a case that stocks have already reaped the benefit of a potential U.S.-China trade deal and a return to moderate earnings growth in coming quarters. But then again, grinding higher while shadowed by worries over valuation and policy issues is exactly what strong bull markets tend to do. For Nightly Business Report, I'm Mike Santoli.
Kevin Mann joins us now to discuss the market and if it can continue higher. He is President and Chief Investment Officer at Henyon & Walsh Asset Management. Welcome, Kevin. Nice to have you here.
Good to be here.
Do you agree with Mike Santoli's last point that bull markets tend to slowly grind higher?
Yeah, and I think we're in a position right now where most investors, whereby they were fearing a potential recession about a month ago, now they're fearing missing out on the next upside in the market. And we have a very confident consumer. And consumers, as we know, are a large part of the U.S. economy. So as the consumer spends, the economy does better. And I am forecasting a record holiday shopping season, which could bring a little Santa Claus rally at the end of the year.
But it's when we start convincing ourselves that the market only has one direction to go that I start getting sweaty palms. What about you?
Understandable.
Yeah.
But I think you look at the underlying drivers of the economy right now, with the consumer at the head front of that being 70% of the economy, we have the lowest unemployment level in 50 years. Wages are rising. And we have a Federal Reserve who has basically told us they're not going to do anything, at least for the next month. That sets the stage for a pretty good stock market rally, although it's going to be kind of limited because of where valuations are right now.
That was going to be my next question.
Yes.
If we do get a little bit of a Santa Claus rally, about what type of a percentage gain do you think is still left in this market?
As it stands right now, we think the market can grow by about 10% between now and the end of 2020, with the bulk of that gain likely coming between now and the end of the second quarter of next year. Once we get into the summer months of next year, then all of a sudden we get to the Democratic convention, the Republican convention, and we could see some trendless volatility until we know who the candidates are.
And who do you think takes us higher? I mean, we've been through a couple of cycles already this year where growth has led the way for a time, then the defensive issues led the way for a time. Now we're back to growth again.
We're back to growth again, but investors are still craving income. They're looking for yield because they can't turn to traditional fixed income sources when the 10-year U.S. Treasury is yielding about 1.7%. So they want growth opportunities. They want some dividend income. That points to dividend-paying stocks.
Kevin Mon, thank you so much for joining us tonight.
It's my pleasure.
And Kevin is with Henyon and Walsh Asset Management.
And as we mentioned earlier, it was a big day for mergers, some of which we first told you about last week. Today, they were confirmed by the companies involved. First, Charles Schwab said it's buying TD Ameritrade for about $26 billion, creating a retail brokerage with 24 million customers and $5 trillion in assets. Tiffany is being bought by LVMH for $16 billion, making it the largest luxury goods deal ever. Many expect LVMH now to expand Tiffany's presence internationally, especially in growing Asian markets. And finally, there's Novartis' acquisition of the medicines company for nearly $10 billion. Medicines develops treatments for cardiovascular disease.
And another deal was announced, this one from eBay, which is selling off StubHub in a $4 billion deal. It is being purchased by a European company called Viagogo. The combined company expects to sell hundreds of thousands of tickets each day across more than 70 countries. And finally, there's a deal that's not being done. HP rejected Xerox's takeover bid after turning down its unsolicited merger offer last week. HP says the proposal undervalues the company.
Now to the economy and the consumer. A new survey says that most Americans plan to spend about as much as they did last year during the upcoming holidays. According to Bankrate, 3/4 of adults have no plans to increase their spending. 22% plan to actually spend less. And holiday spending is exactly what economists are carefully trying to predict right now because, as we saw last year, it's not easy. Here's Steve Leisman.
Will it be a bah humbug or a ho, ho, ho holiday shopping season? The consumer looks in good shape to spend, but there remain major questions. The answer is critical now. A manufacturing capital investment slowdown in the economy means it's up to the consumer to power growth. And last year was among the worst Christmases since the financial crisis. Despite upbeat indicators going in, consumers stunned the retail industry last year, registering zero growth in November and a massive 2.3% decline in December. Analysts cast blame then on a stock market decline in the week before Christmas, Fed interest rate hikes, and a brewing trade war. This year finds consumers with near record low unemployment, high savings rates, decent wage growth, and low debt service.
80–90% of consumers spend their income, and that depends on employment. And so I think wage growth and employment growth are the keys to consumer spending. And the signals there remain quite positive.
Jack Kleinhens, the National Retail Federation economist, wrote, "There is significant economic unease, but current economic data and the recent momentum of the economy show that we can expect a much stronger holiday season than last year." The NRF predicts 4.2% growth in holiday spending, more than double last year's rate. But there are still worries about tariffs, about business uncertainty, and the broader economic slowing. So this year's Yuletime optimism remains colored by last year's disappointment. For Nightly Business Report, I'm Steve Leisman.
Oil prices rose today to remain near a 2-month high. Domestic crude settled above $58 a barrel as global supplies have fallen. But the industry faces a number of challenges, including the amount of debt that's been piling up. Brian Sullivan has more.
The numbers really are staggering. The U.S. oil and gas industry has around $200 to $250 billion worth of total debt, and much of that comes due in just the next couple of years. Let's break it down by type of company in the industry. According to Moody's Investors Service, the exploration and production companies, E&P, are in the worst shape with about $93 billion worth of debt due. The oil services companies, they've got around $31 billion, and the midstream, that's the pipeline companies, they're in hock for about $72 billion. The industry's total debt across all years is about $600 billion, which is nearly half the industry's total annual sales and 10 times more than the entire industry's net income. Think about that. Now, these companies have been able to ride it out the last couple of years or two, but it gets serious beginning next year when the debt bill really starts to come due. And it's not just the big numbers that has the market spooked. It is this. It is that most of this debt is junk related, some of it deep into junk. The purple right there at the top, that is the worst rated debt in the industry. It matters because it makes it more difficult, more expensive, or even impossible to refinance or extend the debt, like many companies did back in 2016. Now, this debt load, along with stagnant oil prices and the pressure on many funds to sell fossil fuel company stocks, have absolutely decimated energy investors. The average return for all onshore oil and gas stocks the past year is a drop of 38%, and many are much, much worse. And this may be the most incredible stat of all. Because of that stock drop that I just talked about and the weight of all the debt on market caps, the combined market valuation of the 55 biggest U.S. onshore oil and gas companies, including Exxon, Chevron, Occidental, and a lot of names you know, is now $400 billion less than the expected value of just one company, Saudi Aramco. One company, the entire onshore oil and gas industry. Energy stocks, they have never been more hated, and debt is a big reason why. It is a big story to watch heading into 2020. For Nightly Business Report, I'm Brian Sullivan, CNBC.
Time to take a look now at some of today's upgrades and downgrades. Netflix was downgraded today to underperform from market performance Wells Fargo. The analyst said that Wall Street is overestimating the streaming service's free cash flow, and then there's the increasing competition. Price target $265, and despite that downgrade, shares actually rose, with the rest of the market was up 1.5% today to $315.55. Prudential Financial was downgraded to sell from neutral at Citi. The analyst cited concerns about growth and low interest rates, which reduce profitability. Price target $86. That stock fell a fraction to $93.67.
NVIDIA was upgraded to overweight from equal weight at Morgan Stanley. The analyst cites investments in NVIDIA's gaming business, which should pay off next year. The price target is $259. The stock was up 4.5% to $221.21. Wendy's was upgraded to buy from hold at Stifel. The analyst cites increased confidence in the outlook for the fast food chain. The price target is $25. The shares were up more than 2.5% to $21.49.
Uber has lost its operating license in London, which is one of the ride-hailing firm's most important markets. Regulators cited persistent safety problems in their announcement, and that sent the stock down about 1.5% in today's trade. Villa Marks has more for us tonight from London.
The relationship between the ride-hailing giant and the London transport regulator has long been a troubled one. Back in 2017, the firm was told that its license to operate as a private hire company would not be renewed because of concerns about criminal background checks of drivers and the fact the firm had not been sufficiently reporting criminal offenses carried out by some of its drivers. And then 2018, a judge granted some relief. For 15 months, they were given a probationary period of a license in order to show that they had changed their ways. That was extended for 2 months in September, and today, Monday, the firm has been told that it will not be renewed. They've got 21 days to appeal. Sadiq Khan, the mayor of London, saying he supported this decision by the regulator and gave some details as to why.
There have been at least 14,000 journeys where unauthorised drivers have been driving people around and they aren't the driver who the passenger thought they were going to be. Another example is we've had drivers who've had their licence suspended or dismissed who have manipulated Uber's system to drive people around, and this has taken a real risk with the safety and security of Londoners. That's why I stand by and support TfL's decision not to grant Uber a licence.
Now, the company says it's taken several measures over the last couple of years to try and allay the concerns of the regulators here. Dara Khosrowshahi, the CEO of the firm, saying that he thought this decision was wrong. That was echoed by his general manager for North and Northeastern Europe, who said that this was an extraordinary decision by Transport for London, or TfL. And of course, they have 21 days to appeal. In order to try and push that appeal process through, they'll have to show that they have sorted this issue out once and for all for the 3.5 million users of the ride-hailing app here in London and the more than 45,000 drivers who could soon be out of a job. For Nightly Business Report, I'm Willem Marks in London.
Still ahead, a wave of homes could hit the market when baby boomers decide to sell, and that could have a big impact on some local economies.
American farmers are receiving a new round of trade aid before Thanksgiving as an end to the U.S.-China trade conflict remains elusive. But not all of that money is headed directly to the heartland, thanks to some loopholes. Kayla Tausche has more.
Between a highway and a baseball stadium sits this urban row house, a single-family home and headquarters of RLD Enterprises, which federal records show received $18,000 in farm aid this year. That residence, this post office box, and this townhouse in upscale Georgetown are among the dozens of downtown D.C. addresses and thousands nationally that have received a cut of the $24 billion earmarked for farmers to soften the blow from the trade war, according to data obtained by the Environmental Working Group, a public policy nonprofit. USDA says a person must be actively engaged in farming to collect aid, but the bar is low.
People who are related to farmers or have some kind of shared risk in a farm can still receive a payment, but they don't actually live on a farm or work on the farm.
Sue Swentner is one of those recipients, an attorney in D.C. by day who manages a farm in Illinois on the side as a way to carry on her family's tradition. She plans to apply for the next round of aid because every bit helps. Other recipients of larger payments, like a sugar industry lobbyist, a retired real estate investor, and an agricultural landlord, defended their qualifications but declined to speak on the record. RLD Enterprises, for its part, hung up when reached by phone, and the U.S. Department of Agriculture did not respond to a request for comment about how it enforces its own criteria. For Nightly Business Report, I'm Kayla Tausche in Washington.
General Electric names a new CFO, and that's where we begin tonight's market focus. Carolina Dybeck-Happy will replace Jamie Miller as GE's chief financial officer early next year. Dybeck-Happy was CFO of Danish shipping giant A.P. Møller-Maersk. She'll be leading GE's global finance organization, as well as being the head of the company's digital technology and global operations functions. GE shares rose 3 cents today to $11.58. Amazon has filed a lawsuit challenging the Pentagon's decision to award a $10 billion cloud computing contract to Microsoft. The e-commerce giant alleges the evaluation process for the contract contained clear deficiencies, errors, and unmistakable bias. Amazon rose more than 1.5% today to $1773.84. Tesla CEO says the company has already received 200,000 pre-orders for its new Cybertruck pickup. The pre-orders require a refundable deposit of $100. The truck was introduced just last week at the LA Auto Show. During a demonstration, its bulletproof windows unexpectedly shattered when they were hit with a metal ball. Tesla was up a fraction today to $336.34.
Facebook and Twitter said data from hundreds of its users may have been accessed after customers used their accounts to log into certain Android apps from the Google Play Store. Twitter says it notified Google and Apple regarding the breach, and there's currently no indication Apple devices were impacted. Facebook rose a fraction to $199.79. Twitter rose more than 1.5% to $30.54. After the bell, activist investor Starboard Value has reportedly taken a stake in CVS. Dow Jones says the stake appears to be small, but both Starboard and CVS recently held talks. CVS shares were volatile in after-hours trading. They closed the regular session up more than 1.5% to $76.58. Also after the bell, Palo Alto Networks reported revenue shy of estimates due to lower demand for its products. The cybersecurity company also gave weak guidance, which it said includes expenses from its proposed deal to buy the cloud security firm Aporeto. Palo Alto shares initially dropped following the news, but closed the regular session up nearly 1.5% to $250.28.
It's being called the silver wave. The Wall Street Journal cited research by Zillow that says a record number of homes will hit the real estate market over the next 2 decades as baby boomers age. The question is, who's going to buy all those homes? Joining us tonight, we welcome back Skylar Olson, the senior economist at Zillow. Skylar, good to see you again. Welcome back.
Thanks for having me again.
First of all, how many homes are we talking about?
Well, I mean, one of the ways to kind of think about this is that roughly a third of homes are owned by those 60 and older. And, you know, if you want to project that into what that means into the future, you're looking at roughly 2 million more homes being released over the next decade than the previous decade, just by the rate of downsizing from that older generation.
You know, you would think with a housing shortage that would be good news for those who want to move into those homes. But some of those homes are in areas that younger people are not as much interested in living in anymore.
Yeah, I think if we're looking from a national picture, it's hard to say really how this will net out because the millennial generation itself is so huge and there are a lot of forced-died home buyers and we've been underbuilding on a national picture. But you're right, as soon as I get to a much more local view, say I'm looking at Rust Belt areas that haven't been able to add the kind of jobs or industry growth that attracts a younger population, or say places that are de facto retirement communities. So they don't attract that younger population by very nature of what they offer to older generations, right, in their exclusivity in those kinds of communities. Those areas, the relative size between boomers and the next generation, Gen X, is going to make it so that housing is going to slow down. You know, prices may really good and truly start to slow down, and sales are going to have a really hard time picking up.
And we should be clear, we're not just talking about retiring baby boomers. We're talking about baby boomers who are moving to assisted living or moving in with their kids. They've been retired already. I mean, in the article, we talk about Sun City, Arizona, which is one of the biggest retirement areas, cities in the country. That will be affected as well, right?
Yes, absolutely. And you know, what we're really getting at for a lot of elements here is really towards those later states of life. So what really, you know, one of the triggering events in one's life that really makes you think to change homes is the loss of a spouse, for example, right? The person that made that last house the home it was. And so if you go through that kind of experience, you know, which I think, you know, many boomers over the next several, you know, few decades will go through, that will cause a lot of housing change.
Something to think about tonight. Skylar Olson with Zillow again. Thanks for joining us tonight.
Yeah, thanks for having me.
Coming up, Disney broke the box office this weekend by shattering all records.
The Super Bowl won't be held until early February, but ads are already sold out. Fox Sports has sold all available commercial inventory for the television's biggest annual event. 30-second spots this year were priced at $5.5 million. Now, ads usually sell out around Christmas or in January, but experts say this year's quick sellout suggests that advertisers have found new appeal in the live game telecast.
UBS is telling clients to buy shares of Hasbro because of Frozen 2, which made history this weekend as the biggest opening animated film ever. The analysts expect strong sales from Hasbro's lineup of Frozen 2 dolls, given that movie's success. That sent shares of Hasbro up 3% in today's session. Shares of Disney, the company behind the Frozen franchise, also got a lift after exceeding all expectations at the box office. Here's Julia Borston.
I'm just living the dream, Anna.
Frozen 2 blowing past expectations in the box office this weekend. Disney announcing today that the film brought in $130 million from the North American box office. With a $350 million global take, a record opening weekend for an animated movie, the film's well on its way to be Disney's 6th film this year to gross over $1 billion.
I think it did exceptionally well at the box office because, number one, you have that built-in fan base. And I think what it did really well at was appealing to a younger audience who had never seen Frozen before, but also the people who grew up with Frozen. The themes of this movie were a little bit more adult, and so it really appealed to the teens out there, so it wasn't just for kids anymore.
What's particularly notable about the success of Frozen 2 is that it comes on the heels of the launch of Disney Plus, which offers the first Frozen and a slew of other princess films at a fraction of what it costs to take a family to the movies. This weekend showed that fans were still willing to pay up for the theatrical experience. And Frozen 2 furthers Disney's dominance of the box office, with 30% market share, 35% if you include Fox. That's thanks to other hits including Avengers Endgame and Lion King.
Disney has absolutely dominated the box office. People are talking about this. How do other studios compete? $10.8 billion so far at the box office this year. They still have Star Wars: The Rise of Skywalker coming out, so that doesn't even include those numbers. We've never seen anything like this in the movie business.
Here you are, enjoy. The annual box office is still down about 7% from the same period last year. We'll have to see whether moviegoers exposed to trailers when in the theater for Frozen 2 return for other films over the holidays. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Finally tonight, America's best run companies. The annual ranking by the Drucker Institute has a new number one. It's Amazon. They knocked Apple out of the top spot due to its focus on innovation. Microsoft came in number 2. Apple rounded out the top 3.
And before we go, here's another look at the day on Wall Street. And it was a record day at that. All 3 major indexes closed at all-time highs. The Dow rose 190 points, NASDAQ up 112, and the S&P 500 added 23. And on that note, that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.